Hello, good afternoon. Welcome to Corporate Governance class. My name is Mrs. Ruth Alao. I'll be taking you through this class. We'll be looking at, in our last class, we talked about corporate governance. I explained what corporate governance is all about. We look at the purpose for corporate governance. We also look at the different stakeholders, their position in governing the corporation. We'll talk about the different level of corporation. So I'll be sharing my slide now, then we can continue with the class. Sorry, just a minute. Now let's talk about what a stakeholder is. Who are the stakeholders? What are their purposes in the organization? Last week we looked at the corporate and we look at governance. How selected individuals, how they coordinate the affairs of a corporation, the affairs of a company. That was what we discussed last week. We look at the level, the state of the stakeholders. Who are the stakeholders? We also look at what corporate governance is all about. We talk about the corporate governance systems. We talk about the practitioner corporate governance. We look at corporate governance in terms of legal definition. But today we'll be starting with, let's quickly remind ourselves what internal governance stakeholders implies and who are the person in charge of the internal governance of a corporation. Corporate governance is all about the system by which a company controls its internal affairs, how they control or regulate, manage the company. Now, we have company management as a stakeholders, we have executives as a stakeholders, we have board of directors as stakeholders, we have other corporate stakeholders, we have the employees, we have the shareholders, we have the debt holders, we have the trade creditors and the suppliers. The suppliers, the customers, everybody that has a stake in the affairs of the company, they are the internal governance stakeholders. But today we'll be looking at, we've talked about corporate governance. Why is corporate governance important? We've talked about it in our last class. Today we'll be looking at the goals of corporate governance. The goals of corporate governance. We know that corporate governance is how it looks into the internal affairs of the company, how some selected individuals, the directors, all the stakeholders I've earlier mentioned, how they control the affairs, the internal affairs of the company. Now let's look at their goals. Their goals. When corporate governance is done properly, it allows the corporation to work smoothly, which is true, due to the existence of a clear level of accountability and communication among the organization, as well as people understanding what their roles and responsibilities are. To properly understand and utilize corporate governance, it is important to understand and follow it. Most importantly, these principles help establish the roles, responsibilities of the key members of the corporation Now, in general, the principle of all forms of corporate governance are related to stakeholders. They are related to board members. They are related to shareholders. Corporate governance place a strong emphasis on the behavior of the corporation and how much the corporation discloses to the public. It's like we've discussed this in our last class, where we talk about keep the interest of the stakeholders in mind, like the directors, everybody in charge of the affairs of the corporation always have in mind the goals of the corporation, treating stakeholders equally, identifying the roles of the board of directors, ethical behaviors, transparency, and the rest. Okay, we are going to start with the importance of corporate governance. The importance of corporate governance. How does it help the organization? How does it promote the organization? Now, the corporate governance helps in the process of giving people different level of accountability. Now, the point of corporate governance is to help the decision making process, as mentioned above in the principles of corporate governance. One of the main goals is to clearly explain to the board, the stakeholders, and the shareholders what their duties and responsibilities are within the company. Now, with knowing those roles and responsibility, the people within the corporation can understand what they are held accountable for. For example, the board has the responsibility of properly evaluating the management in the company. There's hierarchy, there's an hierarchical ladder in governance, in corporate governance, in how what they place who dey place accountable for different responsibility or duties. So there are level of power within the corporation. So the board of directors have a say or has the power to either place anyone in a specific to make decision as regarding placement or terminating people from their position. So accountability is what helps people within the company, is what makes the people to make the decision, whether it is finding out what people should do, should be what person should be terminated from their position due to the mistake that they've made, or who should be acknowledged for their good work due to doing something exceptional in their field. With good corporate governance, it's pretty simple to know what the key members of the business are supposed to do. Now, corporate governance helps in lowering risks. Another important aspect of corporate governance is mitigating or reducing the amount of risk that is involved. Risks of fraud, risks of sharing companies and material companies documents with third parties. Now, through corporate governance, scandals, fraud, and criminal liability of the company can be prevented or avoided altogether. Since the people involved in the organization know what they are accountable for, the actions of one person doesn't mean the downfall of the entire corporation. So properly identifying what the roles in the corporation allows decision to be made that won't have a negative effect on the overall corporation. And it also means that the offender can be much more quickly identified and punished, because each duties, each responsibility has a person attached to it, a person attached to it. So every individual knows the risks, they knows their duty, and they knows the risk attached to failing or not performing within their work duty. So corporate governance is also great because it is a form of self-policing. When you know what can happen to you when your job is not properly done, you police yourself before outside forces are able to do anything to you. a corporation. It is possible for the corporation to handle matters itself. With corporate governance, everyone is held to a specific standard and communication is made easier due to the fact that there is an hierarchical role that everyone involved in the corporation. Now, this level of handling business on its own instead of being forced into making decisions outside of the companies helps the corporation sustaining itself. Now, the second importance of corporate governance is public acceptance. We discussed lowering risks because as an individual, you try as much as possible to try to fulfill to measure up to task, up to what you're expected to do, up to your job description. You try to measure up to the task. You understand? Public acceptance. In terms of business, a company with corporate governance is widely accepted by the public. This is mostly due to the idea of disclosure and transparency that comes with corporate governance. With full disclosure and the ability for people who work in the business to get information, as well as the general public, there is a higher level of trust. There is a lower chance of fraud and company-wide criminal activity, which helps gain the trust of the public as well. Now, the public tend to accept any company with corporate governance because they believe that such company will be transparent enough. Such company is due to the idea of disclosure, as a such company is well managed and it has a higher level of trust. You can trust such company. Now, public image. Today, many corporations hold a high level of corporate governance. This is because a corporation has a public image to maintain. With corporate governance, the corporation takes more responsibility for its actions and also allows it to keep tabs on what is going on, as well as helps those in charge remain more aware of the public image of the company. Definitely, the image of the company in the public will be highly acceptable, will be on the high side, because when a company is transparent enough, people tend to invest in such company. You see, different stakeholders will come in just to have a share in the company, just to invest their money, their investments, because they trust the company, they believe the company is of high standard in terms of corporate governance. With the way that businesses are run today, it can be difficult for a corporation to become successful just by having a high level of profit, due to the fact that a corporation is also evaluated based on its image. Corporate governance is established to help ensure that that image remains clean, making sure there is a high level of awareness, ethical behavior, and understanding of what the public wants is all encompassed in corporate governance. Now, we'll talk about the public image, the public acceptance, and lowering of risks. Now, within the corporate governance firm or company, every risk is ought to be reduced to as low as is reasonably acceptable. Now let's go on with the principles of corporate governance. The principles of corporate governance. Stakeholders recognition, stakeholders interest, board responsibility must be clearly outlined, ethical behavior, business transparency. All these are the principles of corporate governance. Stakeholders is key to maintaining a company's stock price more often than not. However, small stakeholders or shareholders with little impact on the stock price are brushed aside to make way for the interest of majority shareholder and the executive board. Good corporate governance seeks to make sure that all shareholders get a voice at general meetings and are allowed to participate. Shareholders recognition irrespective of the level of the shareholder. Every shareholder have a say. They are equal. They have a say during a general meeting. They have a say in terms of shares and all that. So stakeholders' interests should also be recognized by corporate governance, in particular, taking the time to address non-shareholder stakeholders can help your company establish a positive relationship with the community and the press. Now, stakeholders should recognize, or the corporate governance should recognize stakeholders' interest and also non-shareholders' interest because they can help your company to establish a good relationship with the community and also the press. Now, board responsibility must be clearly outlined to majority shareholders. All board members must be on the same page and share a similar vision for the future of the company. Ethical behavior violations in favor of high profits can cause massive civil and legal problems down the road. Underpaying and abusing outsourced employees or skirting around tax or lax environmental regulations can come back and bite sorry the company hard if ignored. Now, here is telling us that behavior violation, that is favoring high profit individuals, shareholders, can cause massive civil and legal problems. Also, underpaying outsourced employees can cause problem or skirting around tax environmental regulations. It can come back and bite the company if possible. Now, a code of conduct regarding ethical decisions should be established for all members of the board. The last one is business transparency. This is the key to promoting shareholders' trust. Financial records, earnings reports, and forward guidance should all be clearly stated without exaggeration or creative accounting. Falsified financial records can cause your company to become a Ponzi scheme and will be dealt with accordingly. So every business should be transparent enough. Every corporate governance business should be transparent enough so that the public can know or see the image of the organization. Let's look at corporate governance as risk mitigation. Corporate governance as risk mitigation. Corporate governance is of paramount importance to a company and is almost as important as its primary business plan. When executed effectively, it can prevent corporate scandals, fraud, and the civil criminal liability of the company. It also enhances a company's image in the public eyes as a self-policing company that is responsible and worthy of shareholders and debt holder capital. It dictates the share philosophy, practice, and culture of an organization and its employees. A corporation without a system of corporate governance is often regarded as a body without a soul or conscience. Corporate governance keeps a company honest and out of trouble. If this shared philosophy breaks down, then corners will be cut, products will be effective, and management will grow complacent and corrupt. The end result is a fall that will occur when gravity, in the form of audited financial reports, criminal investigation, and federal probes, finally catches up. Bankrupting the company overnight, dishonest and unethical dealings can cause shareholders to flee out of fear, distrust, and disgust. Now, this has explained it all. It's very good for a company to employ or have within their firm corporate governance services. because it helps to mitigate against the risks of fraud, risks of scandal, risks of civil and criminal liability. It helps to enhance public image, the image of the company within the public eyes. It also helps in self-policing the company. It dictates the shared philosophy, practice of an organization and its employees. In fact, it is being said is regarded as a body that any company without a system of corporate organization is a body without a soul of conscience. So corporate governance is very, very important because it helps to mitigate against so many risks overnight. Companies is not about acquiring profit and making profit alone. It's also about having a fair running of the organization, having an organization that is transparent in.
Please unmute yourself, Mrs. Ruth.
The
Go ahead,
end
ma'am.
result of any organization. Okay, thank you, Mr. Yomi. The end result of every corporation without or organization or company without corporate governance is a fall, either through bankrupting, dishonest employees, fraud, and the likes. Let's look at the roles of stakeholders in your business. That's the roles of stakeholders in business. A stakeholder is usually an investor in your company whose action is determined or whose action determine the outcome of your business decision. Yes, every business needs an investor or needs a capital because every business has a budget frame and it needs money either through investors or through loan or capital. Now the stakeholders they invest in your company, they also determine the outcome of your business decision. So stakeholders don't have to be equally shareholders. They are two different things. They can also be your employees who have a stake in your company's success, an incentive for your product to succeed. They can be business partner who rely on your success to keep the supply chain going. So every business takes a different approach to stakeholders. The role of stakeholders differs between businesses, dependent on the rules and responsibility laid out, funding of your company, or as your business evolved over the year. The most common definition of a stakeholder is a large investor that has the clout to hold a viable stake in your company. We have shareholders, we have stakeholders. A shareholders can be a friend, can be your wife, it can be your husband. It all depends. Now, who is registered with you through CAC? You will have a specific share out of 100 share. You might decided to give in 20 out of it, 5% are the likes. But a stakeholders invest in your company, is a bulk investor. He invests in the company with the interest of getting a stake in the company, like a share at the end of the company. There should be an increase in the turnaround, in the inputs or in the outcome of the company. So the stakeholders have a stake in your company. They have something to benefit in the company. So as long as the company is improving, the stakeholders shares is also improving. So the stakeholders makes decisions. They make decisions. So in decision making, the most common gathering of stakeholders is a public trade company is the board of directors. They are the stakeholders. Now, a stakeholders is a large investor or a bulk investor. So you can decide to join the board of directors. They can make themselves board of directors, 6 board of directors, 10 board of directors, as the case may be. So they also comprises of high-ranking executive and occasionally outsiders who hold large amounts of equity in the company. That's they hold large amounts of stake in the company. Any one of these stakeholders has the power to disrupt decisions or introduce new ideas to the company. The board of directors has the power to appoint all levels of senior management, including the CEO, and remove them if necessary. Members of the board dictate the future of the company and are involved in all major business decisions. To be the CEO of a company doesn't mean you are the head of the company that you can do and undo. If you have stakeholders that are invested bulk in your company, the stakeholders have a say in the company because the stakeholders can employ or remove even the CEO if necessary. So we also have direct managing as a role of stakeholders. Direct managing. Why the board of director is a more hand-off approach to controlling a company. Some stakeholders prefer the hand-on approach by directly assuming management position. If a stakeholder is bringing 70% of the investment in the company, the stakeholders might decide that you want to be involved actively within the company, in the management of the company because of his investment in the company. So stakeholders can take over certain departments. They can take over management position. They can be executive director. They can take any form of management position. So such as human resources or research and development, it all depends. To micromanage the business and ensure success. So in privately public traded company, large investors often directly participate in business decisions on the management level. Now let's look at investors. Stakeholders are investors. Stakeholders are regarded as large investors who will either increase or decrease their stake in your company according to your financial performance. Ideally, they act as guardian angels for everyday investors, poring over financial reports and pressurizing management to change tactics of if necessary. So certain stakeholders known as activist investors will make widely unpredictable investments and diversification in order to move the share price and attract media attention to a certain issue. Cain is well known for his high pressure tactics, which is used to mold companies more to his liking. So some stakeholders might decide that you should change your tactics if necessary because they want the company to achieve its aim. They want the media to be attracted by what the company is producing. So they believe changing of strategic either in marketing or in any form can help to improve the image or can help to facilitate the product of the company in the market. Corporate conscience. Large stakeholders are generally high-profile investors and would like to steer clear of companies that trample human rights and environmental laws. They monitor your company outsourcing activities and globalization initiatives and may vote against your company or your business decision if they are deemed harmful to the company's long-term goals. So stakeholders should have corporate conscience or they have corporate conscience in the sense that they try to make investigation before investing in any company because they are high profile investors, people that are well known in the community. So the stakeholders can also take any other responsibility. This is only a broad description of stakeholders' responsibility. Ideally, you will have stakeholders who care about their these four issues, but more often than not, short-term profit take precedence over long-term sustainability. While stakeholders may own your company, it's easier to control your investors when your company is privately held than publicly traded. Oftentimes, the large influx of cash from a successful IPO stakeholders turn out to be a deal with the devil when your company is suddenly taken over by a board of directors that housed you. On the flip side, however, stakeholders can keep your company grounded and focus on its most profitable products and sustain your company's earnings growth. Okay, I believe our time is up. We are going to stop here for today. I will not be giving assignment today because I want to thoroughly go through the assignments that was sent to my mail. So we'll meet in our next class next week. Be prepared for assignments and you'll be getting your a feedback on the assignment you sent to my box. Thank you.